Hello everybody, Tortoise Investing coming at you today with a Hershey stock breakdown. Now Qualtrim Insights has this new thing called scenarios, and we do have a thing set up here. It's going to show us an average annual return rate based off of the data that I put in. If that interests you, hit the subscribe button, drop a like down below, and comment a stock that you want me to take a look at in a future video. You have any questions for me for a future Q&A video, let me know down below as well. None of this financial advice. Always do your own research before investing. Let's go. So Hershey, as well as a lot of stocks, things are looking good this year, and then middle of May it has been a march downward, and you can see that out of a lot of your food and beverage related stocks. And the reason being is this whole Ozempic weight loss drugs got a lot of them scared. If you don't know what Ozempic is, it is a drug that's supposed to make you feel satisfied or full to suppress appetite. And as you see, it's had a little bit of a negative effect on a lot of these stocks, and it's caused a big pullback in Hershey. I personally love Hershey. It makes up about 12% of my total portfolio, and I am long Hershey. I am a believer in this company. They were at one point over $270 a share, and now they have crashed down to around the 180 range. It looks like they've been, zigging back and forth here, but hopefully the bottom's in and we can start that march back upward. Now the thing with Hershey is, over the last couple of years, they've been doing some acquisitions. In 2021, Dots Pretzels, and Lily Sweets brands. Now let's take a look here through Qualtrim Insights. Got adjusted free cash flow yield of 4.23%, dividend yield 2.59%, payout ratio of 46%. Take a look at that revenue over the last 5 years, grown at a rate of 6.75%. Very nice. Free cash flow 12.76% over the last 5 years. Take a look at EPS, 16.69% over the last 5 years. Beautiful, over 10% in the last 10 years. When it comes to their debt, very, very manageable. It is currently sitting at $3.7 billion. Their EBITDA as of last year was $2.06 billion. So my rule of thumb is I personally don't like companies that have more than 3 times their EBITDA in debt. That shows some financial strain to me. Again, it's my personal view on things. But Hershey definitely falls in line there. Not even 2 times leverage. Take a look at the dividend. Dividend's been growing at a rate of 9.41% over the last 10 years, and their last couple hikes have been around 15%. So that is some great compounding to get that snowball rolling. Love it. I'm going to be reinvesting these dividends as long as I'm in the red with Hershey. Now, the buybacks not something that they really do all that much of, less than 1% over the last 10 years. So they nibble at it here and there. And return on capital employed is really where it shines. Usually the market average is around 9 to 10%. Hershey 2020 was 19%, 2021 20.37%, and 2022 21.81%. So their return on capital employed is growing, and I expect 2023 to be pretty much the same story. Now, their CapEx is slowly growing. It looks like it's from 2021 to 2022. It went up by about 5-ish%. And I don't see that as an issue. If your CapEx is going up 5%, but your revenue is going up by more, fine by me. But now if you're having to pay more money to make about the same or less, that's where there's an issue. Now, the new thing with Qualtrim Insights, it's called Scenarios. It's going to be something I'll be using in a lot of future videos. So, the way that this works out, put in your annual compound revenue growth you think the company is going to have going forward. Percentage of EBITDA to revenue. The way we just figured that out is, percentage of EBITDA to revenue. That comes out to about 20%. And CapEx, like I said, is about 5% growth from here to here, 2021 to 2022. And this pretty much is your how predictable do you think their cash flows are. There's low, which means it's all over the place. Medium's kind of your middle ground, and then high is like, Nvidia, Microsoft, Apple, stuff like that. Visa, MasterCard, I'd also put those in the high. So we're going to keep this at medium, just kind of like a margin of safety type thing. And we're going to start this scenario at 2023, and we have updated the market cap here. Now, if you see here on the 5-year projection chart, it does show us the increase in revenue over time, increase in EBITDA over time, and increase in cash flow. Now, with these assumptions, we can pretty much, the middle ground going forward looks like about a 12.9% annual return rate based off of these numbers I put in for revenue, EBITDA, CapEx, and the predictability. Now, I feel pretty confident about this. You can, if you feel a little bit stronger about it, if you think they're going to do more than 6, I mean, you can edit this in here. If you want to do 7.5, 7.5 would probably be my, like, they're really knocking it out of the park. And with that, it gives us a middle ground of 14.5% annualized. But yeah, some really great, I think it's a great price, a great entry point. Again, my personal opinion, always do your own research and stuff. I'm not telling you to go out there and buy this, but if you're looking for consumer stock, might be something that you want to do a little bit more homework on, and definitely check out. But if it keeps dipping where it's sitting at right now, I'm absolutely going to dollar cost average down on this thing. I am a believer in it long term. But yeah, hope you enjoyed that. Again, you're going to be seeing a lot more scenarios going forward. And make sure to comment down below. Got any questions for me? Going to show up in a future video. Any stocks you want me to look at? Again, future video ideas. Hope you enjoyed that. Like and subscribe for more. And until next time, take care. See yous.